Welcome to The Explainer. I am absolutely thrilled you're here today because we've got a wildly high-energy journey mapped out for us. We're going to visually dissect and really try to understand the most devastating financial crashes in human history. We'll be looking at exactly what caused them, who got caught in the crossfire, and most importantly, what we can actually learn from them so we don't repeat the same mistakes. So, let's get right into it. Imagine waking up one morning and discovering that trillions of dollars have just disappeared overnight. Sounds totally impossible, right? Honestly, it sounds like the plot of a sci-fi movie. But as we dig into the historical data, you'll see this unimaginable scenario isn't fiction at all. It has actually happened, in real life, multiple times.
Okay, let's dive into this. If we stretch this out, we can lay out a chronological roadmap beautifully across your screen, spanning literally centuries of financial meltdowns. We're going to track a straight line all the way from 1637 to 2020. We're talking everything from tulips to a global pandemic. And every single one of these points represents a moment where the world's financial systems just broke.
Part 1. Early Bubbles and Depressions.
Now, before we look at our first crash, we really need to nail down the core concept that drives almost all of them, and that is the speculative bubble. Think of this as a massive, unsustainable spike in asset values. It's fueled completely by hype and exaggerated expectations, rather than any actual intrinsic value. Keep this definition in your back pocket because we are going to see it play out over and over again. And the very first time the world truly saw this happen on a grand scale, well, it was centered around something incredibly bizarre: the simple flour.
Now, what's really interesting about this slide is how a seemingly harmless item utterly ruined early investors. Back in 1637, the world experienced its first major speculative bubble, the tulip mania. Basically, extreme speculation caused the price of everyday tulip bulbs to skyrocket to totally absurd levels, before, inevitably, completely collapsing. This sudden drop absolutely devastated local businesses and ordinary people. It established a recurring historical pattern and taught a harsh, foundational lesson: hype does not equal true value.
Fast forward nearly 300 years, we arrive at an event with a vastly different scale, but a very, very familiar setup. The Wall Street crash of 1929. This didn't just ruin a few local merchants, it triggered the Great Depression. The sheer, unprecedented scale of this stock market collapse created a terrifying domino effect that ripped through the entire global economy.
Let's break down the severe real-world stakes of 1929. Much like the tulips, this disaster was fueled by rampant speculation, but this time, it was supercharged by massive borrowing just to buy stocks. When the collapse hit, billions vanished into thin air. And we're not just talking about numbers on a ledger here. This led directly to widespread poverty, countless business closures, and immense government crises. It was a brutal, unforgettable lesson in the severe danger of excessive debt.
Part 2. Black Monday and .com. We're moving forward to the late 20th century now, where technology starts to really amplify the speed of financial ruin. Case in point, Black Monday in 1987. This remains the biggest single-day stock market crash in history. We're not talking about a slow decline over months. It was a shocking, lightning-fast event where markets plummeted globally before most people could even process what was happening.
And this brilliantly illustrates how the introduction of computer trading fundamentally changed the game. Automated trading programs literally combined with human panic, triggering an uncontrollable selling loop. Global markets tanked simultaneously, and over $1 trillion was wiped out in a sudden, massive shock to the system. Investors learned a terrifying new reality. Technology can accelerate panic to speeds humans just can't keep up with.
But notice how the nature of crashes continues to evolve. Side by side, you can see it perfectly. While 1987 was this sudden, computerized shock, the dot-com bubble of 2000 was the exact opposite. It was a return to that long, drawn-out hype cycle, much like our old friend the tulip. But this time, the frenzy was built entirely around the brand-new promise of the internet.
Listen, in the late 90s, if a company simply had .com in its name, people were practically throwing money at it. They massively overvalued these startups and completely ignored basic business fundamentals. But eventually, reality always sets in, right? The bubble burst. Trillions were wiped from the tech sector, companies went bankrupt left and right, and everyday investors who bought the hype were left with nothing. The vital takeaway? Profitability matters way more than hype. At the end of the day, you actually need a functioning business to sustain value.
Part 3. The Modern Global Meltdowns. Let's move to and see how this builds from the previous era into the 21st century. In 2000, that internet hype was at least somewhat isolated to the tech sector. But 2008, that was a completely different beast. The catastrophic bank failures and the housing bubble meant the rot was baked into the very foundational bedrock of the global economy, real estate and banking.
The global financial crisis of 2008 was sweeping, and it was absolutely devastating. Banks were handing out subprime mortgages to people who couldn't afford them, and then wrapping that bad debt up into highly complex financial products. When that massive housing bubble finally burst, major banks failed, triggering a severe worldwide recession. Trillions in global wealth vanished, and the human toll was just staggering. Millions of everyday people lost their homes, their jobs, and their life savings. The hard lesson we all learned? The idea that any institution is too big to fail is a very dangerous myth.
Just a little over a decade later, the world faced something entirely unprecedented: the COVID-19 market crash of 2020. This event saw the fastest market fall in history, but also, remarkably, one of the fastest recoveries. And unlike previous crashes that were driven by internal financial rot or wild speculation, this one was completely driven by an external, global health shock.
As global pandemic shutdowns forced the world economy to effectively hit pause, markets went into a rapid, frankly terrifying freefall. It created an instant global recession. But the big differentiator this time was the massive government intervention. Unprecedented financial stimulus injected into the economy by governments worldwide led to a remarkably swift rebound. It really proves a point. Markets will always react violently to uncertainty, but they are also incredibly adaptable.
Part 4. 4 Pillars of Panic. So, the crucial point is this. If we pull back and look at the big picture, whether we are talking about 17th century tulips, 1920 stocks, 1990s internet companies, or 2008 real estate, 4 behavioral pillars connect them all: fear, speculation, excessive borrowing, and panic selling. Make no mistake, these fundamental human behaviors are the underlying engine of literally every single bubble and crash we've covered today.
Part 5. Lessons from Financial Ruin. I want to leave you with this really powerful thought as we wrap up. History doesn't repeat exactly, but it often rhymes. Smart investors learn from the past instead of fearing the future. By understanding these historical patterns, the hype, the extreme borrowing, the inevitable panic, you can navigate the future of finance with clarity instead of fear. So, what does this all mean for the next big market shift? Well, that's up to us to watch out for. Thank you so much for joining me on this explainer. If you found this breakdown valuable, please make sure to like, subscribe, and definitely comment down below on which of these historical financial crashes you found to be the most shocking. I'll catch you in the next one.